Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Charging Robotics Inc. And it's not exactly the kind of charging that will get your electric vehicle moving. Let's just say there are some financial obligations coming into play. This report is all about Charging Robotics getting a new credit line, basically a loan, to help them grow. The catch? It's tied to them getting their stock listed on a bigger stock exchange and raising even more money. It's like saying, we'll borrow money, but only if we promise to make more money later. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we talk about these things daily. Alright, let's get into the details. The company has filed what's called an 8K report, which is like a quick update to investors about important events. In this case, it's about this new credit agreement. The most important date here is June 8, 2025. That's when Charging Robotics entered into these agreements for a credit facility, which is just a fancy way of saying a loan agreement up to $3 million. The company we're looking at is Charging Robotics Inc., and they're incorporated in Delaware, but their main office is in Tel Aviv, Israel. It is important to know that they are considered an emerging growth company. This means they are a smaller company and get some breaks on reporting requirements. Okay, Charging Robotics Inc. has entered into agreements for a credit facility, a source of money for up to $3 million. They call this the facility loan amount. They got this deal with some lenders, which are just people or institutions that loan money. The company can take this money little by little or all at once whenever they want, but this can only happen after they get their stock listed on a national securities exchange. Think of it as graduating to the big leagues of stock markets. They call this the Uppler's date, the last day. To take this money is either when they've taken all $3 million day in company stock, which is known as equity financing. Here's how they pay back the loan. The main part of the loan, what they call the principal, needs to be paid back when the company raises at least $3 million from selling stock. This date is called the principal repayment date. The loan also has interest, like a fee for borrowing the money, at 12% per year. They call this the facility interest. This interest gets paid back when they raise at least $5 million from selling stock. So they need to raise a lot of money to pay everyone back. But wait, there's more. As part of this deal, the company also gave the lenders warrants. Warrants give the lenders the option to buy 200,000 shares of Charging Robotics stock at $15 Aries per share. This could give the lenders a big profit if the stock price goes up. They can use these warrants once the company's stock is listed in the bigger exchange, and they have 5 years to use them. It's important to note that the company includes what they call forward-looking statements. It's basically the company saying not everything is guaranteed and things might not go as planned. Like the stock listing on a national exchange, it depends on many things and might not happen. The company is also saying that issuing these warrants, these options to buy stock, doesn't need to be registered with the Securities and Exchange Commission, the government agency that oversees the stock market. They're saying it's okay because it's an offshore transaction, meaning it's with non-US persons. So what's the story here? Charging Robotics is betting on its future. They're borrowing money based on the hope that they'll get listed on a bigger exchange and raise even more money by selling stock. It's a risky move because if they don't achieve these things, they might struggle to repay the loan and the interest. Looking at this filing, it's clear that Charging Robotics is in a high-growth, high-risk situation. They need this cash to expand, but they're relying on future events like the stock exchange listing and raising more capital. A strength is definitely their ambition to grow and their ability to secure funding. However, a major weakness is the reliance on external factors. If they don't get listed or can't raise enough money, they're in trouble. One notable risk is the high interest rate on the loan. 12% is a significant amount that could eat into their profits if things don't go as planned. On the other hand, a major opportunity is if they successfully list their stock and raise the needed capital, they could significantly accelerate their growth. In conclusion, this filing tells us that Charging Robotics is a company with big dreams, but also facing significant challenges. Their future success depends on executing their growth strategy and managing their debt wisely. Alright, that's our breakdown of Charging Robotics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.